Peter Major, that's the kind of music you like, a little bit of rhythm and blues,
Yeah, I've
I
learned to
guess.
like the blues.
You are in Idaho.
Yeah, I'm in northern Idaho, Allie. Used to be the world's richest, deepest silver mines. It probably still is, but the volume they produce is dwarfed by Mexico, Peru, and even a couple other countries now. So it's not like it used to be here. Very similar to how South Africa was, you know. South Africa used to be 60, 70% the world's richest, deepest gold mines. They are still arguably the richest, deepest gold mines, but their volume is minuscule. You know, South Africa's gold volume is 2.5% of world production, and Idaho's silver is probably not much bigger of world silver production.
So what are you doing there?
Trying to get a couple more silver mines going and making contact with some of our associates in Vancouver, which is still, it's not the capital raising center of Canada like Toronto, but it still probably comes second to Toronto. And yeah, a lot of our associates that we've been dealing with the last 10 years in South Africa are based in Vancouver. So my original home might be half in British Columbia, half in Idaho, but it's now a third Idaho, a third South Africa, and a third British Columbia.
So a real global citizen. Peter Major is the Director for Mining at Mergence Corporate Solutions based in Cape Town. But it is good to track you down where you are in other parts of the world. I apologize for the fact that we woke you up at 3 a.m. in the morning, but at least it's a decent time to talk about now because, Peter, the gold price, it has been tanking in the last couple of days. And perhaps you've got something more sensible to tell us than what is coming out of the the popular press, which says there was hawkish sentiments in the Federal Reserve Open Market Committee, and as a consequence of that, gold needs to be sold.
Look, I like to think I'm an historian because I really believe in history. And I believe, as Mark Twain said, history doesn't always repeat itself, but it sure rhymes. And we can learn a lot from what happened in a similar environment back in the 70s. Whereas, like we saw in this millennium, we had high gold price, just like we did in the 70s. It was triggered differently, though, in the new millennium. In the 70s, it had been released from being held down for 40 years. So you had that natural uptick. And then you had high inflation. And when interest rates were 3, 4, 5% negative, it made sense for all commodities to go up. And that was very similar to the last 5 years here, certainly the last 3 years. You know, we started seeing inflation moving up with COVID. And boy, we've seen real inflation the last 12 months, you know, repeatedly 7, 8% in the States. And that's real inflation. And the Fed was a little late. But now, this is where history differs, Alec. You had Paul Volcker, who was doing double increases sometimes. Instead of 1% at a time, I think he gave us 2% at a time. He put the real rates way above inflation to make sure it came down. But now the world, believe it or not, is a lot more fragile. And I'm seeing a lot of pretty respectable commentators, economists, fund managers saying, there's no way our Fed is going to do what Paul Volcker did because it'll bring the financial world to a halt. You know, we have taken on a lot more debt. The world has taken on a lot more debt than it did back in the 70s. So if you get those interest rates at 4% above inflation, well, we know that's going to be double digit. That's going to be 11 or 12. It'll blow everybody's budget to kingdom come. So, and the world's also more integrated, even though Russia looks like it's not. The world is integrated and it needs to work together. It wants to work together. So I'm leaning towards economists who say these interest rates have now gone up pretty quick and they may go up 1 or 2% more, but they are going to come off a lot quicker than they did before. And they're not going to go up so fast that they're going to be higher way higher than the inflation rate. So I'm not a big bear in selling gold now. I was selling gold when it cracked 2000 because everything else was lagging too much. There were just a lot better, cheaper investments, safer investments. But as you pointed out, gold's been falling for 3 years now. Gold peaked at just under 2,100 an ounce back in 2020, over 2 solid years ago. And it's been tapering off since. It kind of shoots back up, falls a little lower, shoots back up, not as high, falls a little lower. So now, what are we at today? 1745. So that's a good $300 below what we were 3 years ago. And the other commodities, oil, is oil more expensive than gold? Yeah, it is. And oil is probably a lot higher than its long-term average than the gold price is. And we know Major's always talking about long-term averages, but yeah, I think the last 80 years, the long-term average of gold is probably 920, 930. Well, we're not double that anymore, but the oil price is more than double its long-term average. Uh, I don't have any new insights, but I'm not as worried that gold is going to repeat what it did in 1981, 1982, when it fell from $850 to 450. That was a 50% fall in literally 12 months. I just don't believe it's going to do that. I don't even think it's going to fall another $200-300 because there is high inflation in all other areas of the world, property, other metal prices. So relative to them, gold doesn't look that expensive, and it's our longest, oldest commodity. It's our most trusted monetary instrument, I believe.
So
Second to
if you
Bitcoin, huh?
second a bit, well, Bitcoin believers say it's the new gold. But going back a little bit into that history, does that tell us that the $80, $85 an ounce that gold has dropped by in the last 2 days? Because this is by any means it's a sharp decline. Is that consistent with what we saw when interest rates started rising last time around, even though a Volcker repeat, as you say, is not likely?
Yeah, that is consistent now. But I think let's stay with percentages rather than these dollar amounts because, yeah, what is $85 on a $2,000 gold price? It's not even 5%. So it's a 3-4% fall, and hell, we've seen a lot of commodities dropping 4.5% a day, and I haven't compared all the volatility of metals here for a while, but I'm pretty sure gold's volatility is in the lower half, probably the lower quartile. It's very liquid, it's very widely held, and it's unlikely to have something just come and replace it. But like a lot of other commodities, how platinum was all of a sudden replaced by palladium, and maybe rhodium was replaced by platinum, and copper. Hard to say it's replaced by aluminum, but it was being replaced by aluminum in high transmission wires. It's not as efficient, but the price differential is so high. But you know, where's the even in diamonds? For years we said, how are you going to replace jewelry demand for diamonds? Because there's no other substitute. Well, there is. There's artificial diamonds, and it hasn't been an overnight replacement, but it is becoming a replacement. De Beers is even indicating that they're not opening new mines. They're running out the mines they've got. And yet gold kind of stands unique. What has even come close to replacing gold? But we've had a lot more commodity ETFs, a lot more commodities placed in bars that the average person can get. But has that really lowered the demand for gold? I think minusculely. And has Bitcoin lowered the demand for gold? Maybe some, but I think almost immeasurably. It's almost too small to measure. So yeah, I don't see any immediate replacements or alternatives to it. And as we've created trillions of more dollars, and billions of more people these last 40 years since 1980. How much more gold have we produced? We've probably taken total production of gold from maybe 1,100 tons in 1980 to we're about 3,300 tons a year. And I'll tell you, it's been at 3,300 tons literally for 20 years now, maybe 15. We're not producing much more gold these last 5 or 10 years.
Can we? Is it possible to?
If the price goes up, yes. Yeah, if the price goes up, we can produce more gold. But Alec, maybe 10%. I think it'd take us literally, it would take us 5 years at a much higher gold price to probably increase total per annum production from 3,300 to 3,600 tons a year. Yeah, it's gold is hard to move. That's why you can bury gold, you can drop it in the ocean, you can put it in a safe, and then compare the three when you dig them up. It's almost nothing affects it. You can't tell, wow, this gold was at the bottom of the ocean. No, this gold came out of Fort Knox. Oh, this gold came out of the backyard with rainwater and soil. It's impervious to that. So it's impervious to damage. It's impervious to erosion. It's impervious, I think, to sediment, pretty much, compared to all these other instruments. The dollar, the euro, the yen, Bitcoin. I mean, Bitcoin's volatility puts golds to shame. Jeez.
Indeed.
Yeah.
Well, Peter, just looking at the reasons why the gold price has been volatile in the last few days, there were also those who were saying that the dollar index is now at a 19-year high, and that is not good for gold. It's so confusing with gold because sometimes you buy it because inflation's going up. It's a hedge against inflation. Other times you buy it because the dollar's going down. When you look at it, taking all of that off the table, all the BS, because there's a heck of a lot of BS that is involved in, particularly in this market, what should a owner of gold be looking at? Is it a trading metal? Is it something that you put into your portfolio as a long-term insurance? And after that, should you be buying it now?
Alec, I've always been a relative person. So I start out saying there's five main assets that people usually buy for thousands of years. They buy, maybe it starts with gold, and then probably second was land, property. And then maybe it was the advent of some kind of currency. So we call that cash. And then long-term currency, more than a year, is called bonds. And then the fourth is probably the newest. That's we call equity. So that's how I've always, as a fund manager, I always say, how do each of these five asset classes compare relative one another? And yeah, I start out with historical means because most of these five asset classes are fairly cyclical, or they're in a sine wave, and you anybody can do this. You don't even need to go to school to do it. Just say, where is gold price today relative to property? Where is it relative to the S&P 500? Because that goes back, a good 110 years, or you can go back to the Dow, which probably goes back even further. But and go to cash and go to bonds. So let's start with equities. Right now, it's actually below the mean of where it trades to the S&P. So historically, if you're talking reversion to the mean, gold is cheaper and safer at today's price than it is the S&P 500. And the S&P 500, we've seen its ratings come all the way down to a 7 PE. And I think it's currently on a 20 PE. But if you got high inflation, and look at the earnings, that's what scares me, Alec. The earnings on this S&P, they are way out of, I think, 2 standard deviations above the mean. The profit margins are above a standard deviation of the mean. So the US has had record profit margins and record earnings. And when your profit margins can't go higher, that means they're going to start going lower. And when your earnings are so high that they just can't go higher, like they're not going higher now, well, then they're going to come lower. So the rating on that S&P at a 20 PE, it can easily come down to an 18 PE or a 16 PE and still be, I'm trying to think what its long-term mean is. I think it's probably 16. So gold right now looks cheaper and safer than the S&P 500. So I would say you got to have some gold in your portfolio now to balance out your equity position. Then we go to property. Now, if I'm anywhere but South Africa, property kind of looks cheap now. It really got smacked and it didn't recover after COVID. But I'm telling you, the rest of the world sure didn't get smacked that bad during COVID, and it really recovered after COVID. So whether it's Vancouver, whether it's Manhattan, California, I saw a notice just days ago that some house in Seattle had to lower its asking price $100,000 to make the sale. Now, they didn't say what that house was selling for. Was it an average house selling for $1 million and they dropped 10? But what is significant in the States is nobody's had to visit a house to sell it. You didn't need any buyers to come see your house. People are selling on the internet. People are selling on the phone, and most of them are getting it bid higher. It is a frenzy like we'd never seen before. So now somebody had to sell at 100,000 discount compared to what he wanted just to make the sale. And we're seeing in Vancouver, that was the world's hottest hot market this millennium. That means 20 years running, Vancouver is the hottest. It barely came down. Canada's house prices barely came down in 2008. And we know what America's prices did in 2008. Geez, they fell big time, 30, 40%. So property prices the world over, on average, are pretty darn high. They're at all-time highs, even in real terms. So gold is looking real good compared to property. It's looking nice compared to equities. So now you say, what about cash? Okay, short-term interest rates, yeah, they can pretty easily come up another 2 or 3%. So I think they're currently about 3. So they come up another 3, you're getting 6%. So if you buy a brick of gold today at 1750, how's it going to come? I didn't do the relative to the long-term money market rate, and that's important. I wanted to do that just before the program. Then I could tell the audience where we are relative to cash. Gold, I'm guessing it's maybe neutral to a tad expensive to cash, which means you might want to hold a little cash now. You want to hold cash a little more than you want to hold gold. But gold bonds, there's no way I would rather hold a bond right now than gold, because if interest rates go up another 2%, you're going to lose it on the bonds. So let's see. Maybe cash is a little more attractive than gold now, but to me, equities are not more attractive. Unless you're in South Africa, property is definitely not more attractive than gold. And you got holding costs with property. You got taxes to pay. So I'm sounding like a gold bull, and I think for years I was a Mr. Negative on it. Yeah, I was in 2020. It just shot way up too high, too fast compared to all these asset classes we're talking about. Now, if you are positive on gold, that means gold shares you should be buying, right? Because they go up multiples of the gold price. And I see, Anglo Gold, Gold Fields, they're trading at bigger dividends than we've seen, in at least 10 years, I think. But just remember, when you buy a share has a lot more risk than the commodity. The commodity really has price risk. And if you're in South Africa, if the commodity falls in dollars, it usually the rand counters that out. But if you buy a share, you have government risk, you have management risk, you have union production risk. So I've looked at gold compared to Anglo Gold. Anglo Gold looks too cheap. But geez, if any company has been badly managed the last 25 years, Anglo Gold's got to be at the top there. And we know Mark Cutifani was a very good manager at Anglo American, but if you look at how he did at Anglo Gold, I think Mark came in with a real mess when he took over, and had he not cut those hedges, the company would have almost been bust now. And how he not start extracting it from South Africa, the company would have been in a lot worse shape. So I think Mark did a lot of good at a very difficult company, but it doesn't look like they've done much good since he left. And yet, I've bought some Anglo Gold just because I think the gold price has fallen a little too much, and Anglo Gold relative to the gold price has fallen too much. So that's the double insurance I think I'm taking out.
Peter Major from Mergence Corporate Solutions. I'm Alec Hogg from biznews.com.